All right, let's talk about one of the most powerful, almost magical forces in the entire financial universe: compounding. It's been called the eighth wonder of the world, and for a really good reason. If you've ever wanted to truly understand how to make your money grow almost on its own, well, this is the breakdown you've been waiting for.
So here's the big question, right? How do you get to a point where your money starts working harder than you do? It's the dream, isn't it? Reaching a place where your investments are bringing in more cash than your day job. Now that might sound like some kind of fantasy, but it is a reality for so many people. And the key, it all comes down to two simple but incredibly powerful ideas: dividend growth and reinvesting. Let's dig into exactly how they work together.
So here's how we're going to break it all down. First, we'll look at the real power of growth. Then, we'll peek under the hood at the compounding engine itself. After that, we get to the fun part, seeing the incredible snowball effect in action. I'll show you how to start building your own. And finally, we'll talk about the ultimate payoff. By the end of this, you'll have a clear roadmap.
Okay, let's jump right in. A lot of people think dividend investing is just about, collecting those quarterly checks, and that's fine, but that is barely scratching the surface. The real magic, the place where life-changing wealth is actually built, isn't just in the dividend, it's in dividend growth. So why is that growth component so darn powerful? Well, it's kind of like this amazing 1-2-3 punch. First, your income just grows automatically. We're talking about solid companies that make it a priority to give their shareholders a raise year in and year out. Second, that's usually a sign of a really healthy, growing business, which often means the shares themselves become more valuable over time. And third, and this is the best part, it's passive. The raises just show up. You don't have to do a thing.
This quote just nails it. Seriously, imagine your boss calling you in every single year guaranteed to give you a raise, and you never even had to ask for it. That is exactly what a good portfolio of dividend growth stocks does for you. It's a total shift in how you think about your money working for you.
Okay, so we've got this awesome idea of an automatic pay raise, but how does the engine behind it actually work? What are the gears and the moving parts that make this whole machine run so smoothly? Well, it really just boils down to two key pieces. First up, we've got the dividend growth rate, or DGR. You can think of this as the fuel for our compounding engine. It's just the percentage that your pay raise goes up each year. So an 8% DGR means your income from that stock just grew by 8%. The takeaway here is really simple. The higher the DGR, the faster your financial snowball gets rolling.
And the second piece is the DRIP, which stands for Dividend Reinvestment Plan. Now, if the DGR is the fuel, DRIP is the turbocharger. Instead of just taking your dividends as cash, a DRIP automatically uses that money to buy you more shares in the company. So now you have more shares, which means you get more dividends, which then, you guessed it, buy you even more shares. It's this beautiful self-feeding loop that puts the whole growth process on complete autopilot.
So, let's put it together. You have a dividend that's growing every year. That's your DGR. And you're automatically using those dividends to buy more shares. That's your DRIP. When you combine those two forces, boom, you unleash the legendary snowball effect. And yeah, it starts off small, but you just give it time, and it becomes this unstoppable avalanche of wealth.
Let's make this real with some numbers. Imagine you invest just $200 a month. After 10 years, you've got about $34,000. Pretty good, but watch what happens next. This is where the magic really kicks in. In the next 10 years, it almost triples to $95,000. Then it more than doubles again to over $230,000. And then in that final decade, it just explodes to over $500,000. Look at that. The growth in just the last 10 years is more than the entire first 30 years combined. That, right there, is exponential growth. The money you earned way back in the beginning is now earning its own money. Time is, without a doubt, your most valuable asset. Okay, those numbers are awesome, but the big question is, how do you actually start building a snowball like that? Let's get practical here. It's honestly a lot simpler than you might think to get started.
First thing to know is that not all dividend stocks are created equal. You can kind of think of them in three main groups. You've got your dividend growers, think fast-moving companies like Microsoft or MasterCard. They offer really high growth potential. Then you have the dividend aristocrats, like Coca-Cola. These are the super reliable ones that have raised dividends for 25 plus years. They give you amazing stability. And finally, you've got your high-yield slow growers, like utility company, which give you more income right now. A really solid portfolio usually has a healthy mix of all three to get a nice balance of growth, stability, and income. So how do you actually put it all together? It's really just a four-step process. First, and this is absolutely the most important part,
You have to research and choose high-quality companies. Second, log into your brokerage account and turn on DRIP. Seriously, it's usually just checking a box. Third, add money consistently. Every paycheck, every month, whatever works for you. And finally, the hardest part for most people, just stay invested. The biggest mistake you can make is trying to jump in and out. Just give that snowball the time it needs to grow.
All right, so you've done all this. You've been disciplined for years. What's the ultimate payoff look like? How do you even measure your real success? Well, there's this fantastic metric called yield on cost, and it is the perfect way to see the true power of your initial investment over time. Look at this number, 8%. What does that mean? Well, imagine you bought a stock 10 years ago, and at the time it had a 3% dividend yield. But because that company has been steadily raising its dividend year after year, today you might be earning an 8% return, not on today's price, but on your original investment. That's your yield on cost. It's just a beautiful number that shows what your patience has earned you.
So here's the bottom line. Your income stream from an investment can literally double or even triple over time without you ever having to put another single dollar into that specific stock. That is the incredible, unbeatable power of combining dividend growth with compounding. It's a strategy that rewards patience above all else.
So, we've covered a lot here, from the mechanics of how this works to the massive power of that snowball effect. If you found this valuable, if you learned something today, do me a huge favor and hit that like button and subscribe to the channel for more explainers just like this one. It honestly helps us out a ton.
And you're definitely going to want to be subscribed for our very next explainer. We're going to be covering the biggest dividend investing mistakes beginners must avoid. It's the perfect follow-up to what we talked about today and will help you protect and grow that snowball we just built.
So I'll leave you with this final thought. Every massive snowball, every avalanche starts with just one tiny snowflake at the top of a hill. Your financial future is that snowball, just sitting there waiting to be rolled. The only real question is, when are you going to give it that first push? Thanks so much for watching, and I'll see you in the next one.